What is going to happen and what will cause a lot of heartburn at the Fed, Henry, is that I watched the 2 to 10 year the yield spread, and that when it goes negative, as it did in November of 2006, was an unbelievably accurate predictor of a recession 1 year later, which began in December 2007. Remember, the equity market, the S&P 500, reached new highs through the first half of 2008. And we had Jean-Claude Trichet, who was head of the European Central Bank. I call him the hapless Mr. Trichet, because on July 2nd, 2008, he increased interest rates 2 months before the sky fell, thinking that inflation was the major danger. Now the Fed is in a reverse position. They think Fed inflation somehow will go up. They are making the reverse mistake. It's not going to happen. The bond market is going to tell you that as short-term rates increase, the 2 to 10 spread is going to narrow, and you're going to talk about slowing growth and also in terms of a potential for a recession.
So you are focused on the yield curve. You've mentioned the R word that a lot of people say is not in the future at all. Do you think that we are headed for a recession later this year or early next?
I'm saying that now through the end of 2018, we are looking at slow growth. But I will revise that view if I see the bond market give me a different signal. I've always believed that the bond market is a better leading indicator of a recession. It was in the recession of 2001. We had a recession from March to November. It was a short recession. And the bond market went negative about a year to 15 months prior to the beginning of the recession. In this case, in 2008, 2007, 2008, we have a signal of 1 year. The problem with the stock market is it turns out to be either a coincident indicator or a lagging indicator, so you cannot place as much confidence in equities as you can in the bond market.